everybody, and welcome to this webinar. I'm Sumaira Abdi, and with me today I have two experts, Santosh Joseph, founder and CEO of Germinate Investor Services, and Radhika Gupta, who's the MD and CEO of Edelweiss AMC. And the reason I've asked them to join me today is because we want to talk a little bit about balanced advantage funds. But before we do that, I want to just lay the context a little bit. So I know a lot of you watching this may probably already know this, but for those who don't, there are five kinds of mutual funds. Okay, so there's equity, there's debt, there's hybrid, there's solution oriented, and then there's others, right? So solution oriented are all these retirement plans, children's plans. Others are ETFs, fund of funds, etc. And equity and debt, of course, is commonly known. Now, hybrid is the category we'll be focusing on. Within hybrid, there are six varieties of hybrid, right? So there's the conservative hybrid, there is the balanced hybrid, the aggressive hybrid, there's the dynamic asset allocation or balanced advantage. This is where we're focusing on. And then there's the multi-asset allocation, there's arbitrage, and there is equity saving. So these are the kinds of hybrid funds which are there. Out of this, we are choosing today to focus on the balanced advantage fund. So Radhika, first to you. There are so many different funds. And then within hybrid, there are so many categories, right? What sets balanced advantage apart from the rest of the hybrid pack, and why does it make sense for an investor?
So I think the balanced advantage category, which has always been my favorite category, solves a very basic investor need and a very basic investment problem. I think the investor need, when I look at most of us as investors, that we want moderate returns, but we do want downside protection, because the fact is markets are volatile. We are sitting on the back of 2020 and talking about this. But you have periods like March where markets fall 30%, and many of us are not comfortable with our portfolio falling 20-30%. And you have periods of rally. So I think the balanced advantage fund achieves that blend of meaningful upside protection and downside protection. The second question that you asked is, how is this different and what does this do differently from the rest of the hybrid category? I think what distinguishes balanced advantage funds is they hold a combination of equity and debt, but that ratio keeps changing. So that ratio could be 30% equity, 70% debt, or 80% equity, 20% debt, on average 50-60%, and it changes basis market conditions. And what's really important here, and I'm sure we'll talk about this, is that the change is based on automated factors. It is very, very hard to time markets. All of us have seen that emotions play a big role. Balanced advantage funds, in some sense, automate that process of moving in and out of markets so that you can get the most out of them without losing a lot.
We'll come back to that in a little bit, but first, let me just get some thoughts in from Santosh. Santosh, today is the day that the Sensex has hit 50,000. Is this an environment in which you're recommending balanced advantage funds? Which is the right environment, or is it something that's meant for all seasons?
Yeah, I think when people who are watching the news see those congratulatory notes of Sensex hitting 50,000, the first thought crossing into an investor's mind, now if he's invested already, he'll be wondering, hey, is this the time to take out my money? Because when you look at it from the lows of March 2020, is almost about 90-100% higher. And for an investor who's looking to invest in equity, he's wondering, is it an all-time high? How is the best way I can enter into it? And is this a perilous times to enter? So therefore, when you look at these two predicaments, by one, an investor who's already invested and an investor who's looking to invest, balanced advantage funds possibly is a great solution. Reason is that you have a great combination of fixed income and equity managed and packaged well to take care of the benefits of either all-time high, or even for a guy who's entering today, that the all-time high will really matter significantly lesser than directly entering into equities through a direct diversified fund route. So I think it's a win-win for both, and this is where you get a beautiful crossover between choosing and timing the market by remaining to stay invested or entering at the times like where markets are at all-time high.
Radhika, I just wanted to ask you an industry question. I'm sure you would have spoken with most of your peers. BAF is when an investor hears about it, they hear that it's more automated, right? Now, how exactly does this automation work? How much is the contribution of the fund manager, and how much is the contribution of the process?
Sure. So I think there are three parts to any BAF if I was judging the BAF. There is an equity component because you're holding whatever 50, 60, 70% equities. That can be automated or not. It's just picking stocks, right? So however the fund picks stocks. Then there is fixed income. That's however the fund manages fixed income. And the third, which is the most important part of the BAF, is the shift between how much equity and fixed income. So am I 80-20, am I 30-70, whatever I am. I think if you look at most, if not all of the industry, that process is highly automated. In fact, I would go so far as to say in most peers, there is no level of fund manager discretion, which I think is a very, very powerful thing because globally also, people don't time markets well, including fund managers. You want to let it be a process. However, how that modeling happens or what factors people use to do that, because ultimately any automated process uses some inputs. So I can automate the process by saying I look at price to earnings levels and then decide how much equity I'll hold. Or I can say I'll look at last 50-day market performance, which is another way to do it. So there are different ways by which you can make that change to equity levels. Everybody automates it. They use a different model in the background.
Okay. Santosh, since you would have studied most of these schemes, is there one model which is better than the other? I mean, if there's an investor who's watching this right now and, I mean, should they be looking out for this, which is the kind of model a fund is following, to sort of shift their allocation between equity and debt? And therefore, is one more effective than the other?
Well, that's actually a tough call. When you actually have selected, BAF as your, allocation for funds, you realize, like Radhika said, each of them have their own models that they have in place. Now, you'll notice that if the model is built aggressively, you'll do very well in a rising market scenario. And if the model is a little conservative, you'll fall less. I think trying to choose only because of a model is going to be a little counterintuitive here, because what's going to happen is that you will again see a small cycle playing out within the BAF category. So what is better is that you take the BAF, diversify within the allocation of your money in BAF to maybe one or two BAFs which have distinct models that play. Now, some people follow a price to earning, some people follow a triangulation between price to earning, price to book, and even some level of momentum that the market is playing out. Some people take the very conservative approach of fixed income plus kind of a return orientation. Some people look at equity or equity kind of return orientation. So what is ideal for you is just take a combination of maybe one or two by diversifying within the BAFs so that you get the best of the entire BAF and the models that are available in the market.
Follow up to that. Therefore, I mean, since it's automated and, I get all the advantages, right? But is there any evidence to suggest that BAF has given, better risk adjusted returns than an investor who might want to invest separately in equity and debt? I mean, why will I not take the specialization of, two fund managers separately, as opposed to combine it together in a BAF?
So I think, Sumera, you can do that. I think there are three parts to it. You can do equity and debt separately. One is that, as we've been saying on the show, timing is very, very difficult. So even in March, if you were doing equity and debt and you had to shift the allocations yourself, would you have the courage to go into equities in March or April? Probably not. I mean, I know a lot of investors at the time the Biden election happened, they wanted to jump into equities, but they just could not, right? Because of all the noise around them. So one, I think it's easier said than done yourselves. Secondly, BAFs are more tax efficient to do the shift. If you try to do the shift yourself, and BAFs are very, very dynamic when they do the shift, you will be paying taxes. Because of the mutual fund tax structure, it becomes a lot more advantageous. So I think there are cases for letting this happen in a more professional way than trying to do it yourself.
Okay, Santosh, a follow-up to you then. One, of course, is this, that, what do you recommend to clients? Go for a BAF or go for equity and debt separately. And the other thing that I want to ask is that, in terms of the selection of a BAF, right? I mean, this is a category that has become very popular now. What are the key factors? Should they be looking at the fund managers? Like you said, that the process just by itself, is not the differentiator. What should they then look for? I mean, how is one fund better than the other? Is it the past returns? Is there evidence to suggest that past returns, can be, it'll be consistent going forward as well? What do they look for?
Maybe you can look at maybe a little more granular angle to this, that past returns are maybe a nice way to highlight how a BAF has worked. Now, we should also understand that when someone comes into BAF, he wants to get into equity, but he wants a hedge around equity in terms of downside protection and upside participation. So when you actually show returns, I think rather than just show the performance, what you I think can highlight is the performance of the fund, which shows the upside and downside capture. Now, when you take, let's say, 2 or 3 funds that are there, and I think you should use a little longer time and maybe use a combination of CAGR and calendar returns to show. Let's take for the month of March. Let's take Jan to March as one period, and then April to Jan right now as another period. You can easily show difference between how a model has worked effectively in a scenario where the markets just collapsed 30% in a really short time, maybe about 20-30 days. Two, in the next 9 months, you had market going higher month on month. So did the model work dynamically by on one side protecting your downside up to March 31st, and after that did they regularly keep increasing equity allocation because they felt favorable market conditions? Show that as a case in point. Within that, figure out which are the funds that captured both the downside protection and the upside, and figure out the fund size and the model, and understand that the risk that the client is looking for, does it match along with the model itself, and then you take a call. So it's just not just the returns. For example, we have 3 funds and one is about 2-3% higher or 2-3% lower. That's just a beginning point, but then you have to look at both the upside and downside capture and the size of the fund. And again, some people like to go with the fund which has at least got a 5-year plus track record, and some people don't mind looking at a new fund if it's going to be a BAF category, because they like a fund house and the process that the fund house is followed for other investments to consider.
Mr. Sanjay Deshpande has reminded us of a question which I had promised to ask, but I didn't. So he wants to know how exactly is this balancing done between equity and debt, because naturally when equity is high, debt is low. Radhika, Santosh, who would like to take it?
Yeah, I'll take that. I think there are multiple approaches, and Sanjay, that's a great question in terms of how rebalancing is done. So I think there are primarily 2 different approaches without generalizing too much. One approach, typically, as Santosh says, typically follows price to earnings kind of model. So in this kind of approach, typically when equity markets have run up like they have right now, price to earnings ratios will be high. So the BAF will hold a little less equity and more fixed income. This is a common approach that is followed. There is a second, more momentum-based approach which says that when equity markets are doing well, when the weather is kind of healthy, I will hold higher equity allocation and lower fixed income allocation. When markets are lower and they're volatile, etc., then I will hold lower equity allocation. So there's no one answer to this question. These are broadly the 2 approaches that are followed in the market. I think Santosh made a point earlier in this webinar that is why because there are different approaches, you could pick a BAF that has one of these 2 approaches and have multiple BAFs in the same portfolio and have 2 complementary products.
We spoke about whether BAFs are good for new investors or seasoned investors. We didn't talk about whether it's good for young investors. Now, I'm guessing new investors can even be people, who are older. So therefore, we have a question from Sukesh Shetty saying that, would it be suitable for young investors, considering that, they have an opportunity to go for a mid-cap or a small-cap fund, given their long time horizon, and therefore, how does BAF stack up?
So, Sukesh, the very interesting part is that, especially when you call yourself young or starting off new, which means you have a longer time horizon, you may think that you're more suited to take a slightly higher risky product like mid-cap and small-cap. It is right, but there's a just a regular challenge, that is that when you start today in a mid-cap or a small-cap fund, that there are cycles that are going to play out in the markets in general, and within that, the mid-cap and small-cap. We have very recent memory that serves us saying that 2018 and 19, and maybe even a large part of 20 was a really rough year as far as mid cap and small cap investing was concerned. Now, at that particular point of time, are you going to drop the towel or face the exhaustion of staying invested? Because here the winner is the last man standing when you're an investor. Now, therefore, if you were to keep the end in sight and say you want to stay invested for a long haul and you want to make a superior return, you have to avoid anything that takes away your attention from staying invested. And therefore, you could also consider BAFs for a long term investing because it makes investing easy, simpler, avoids exhaustion or the lack of inspiration and motivation to add more money or to continue to stay invested. So, while I'm saying that mid cap and small caps are great for young and long term investors, it's not that BAFs are against you, even they can go well for you, but for two different reasons.
Radhika, just to wrap up the show, when we, track, say, auto sales, right? When we track sales of new houses, the one key monitorable that people talk about, or at least the companies talk about, and they say, inquiries are increasing, or that, inquiries are not increasing. So, and you're very active in terms of your engagement with investors. So, what would you say about balanced advantage? I mean, are inquiries increasing? I mean, for me, that is the real test, right? Not that a distributor has come or an advisor has come to convince me to invest in this. Is it that am I actively seeking to know about something that I should be using for my investment? So, what has been your experience?
So I'll just give you a couple of data points on inquiries are increasing. I think if you look at the AMFI publishes data on various industry categories and the sales that are happening, and I think BAF is one of the categories that is getting the highest gross sales today. So I think that is a metric that at least people are interested in the category. I think if you look at the number of investors that most AMCs are seeing, even touching our websites, forget actually investing, but touching our websites and our BAF product pages, etc., I think that is increasing. And I think the number of investors coming into the category is also increasing. The folio count in the category is increasing. So I think these are all very, very encouraging trends. I mean, among domestic equity funds, this is a category we answer a lot of questions about. And I think a lot of AMCs, to give everyone credit, are building awareness about BAF as a category. I mean, 3, 4 folks have done major, sort of awareness campaigns. A lot of people are trying to build out awareness of the dynamic asset allocation or BAF category. So I think in many ways, yes, inquiries are increasing.
Santosh, what has been your experience? Are you having to talk to clients about balanced advantage funds, or are they coming and asking you about it?
It's both. In fact, what is interesting is when we want to tell people that they could invest more money, and then the common apprehension is market being at an all-time high, or the whole of last year that markets are so volatile. You are wanting to give them the confidence, saying that we can have a better handle in terms of managing market and your emotion. So if one were to say, how do I better manage the market or the investor's emotion, then I think the natural veering is towards a BAF product. Now, for the people who are whom we are going out for, this is the answer. Now, the people who are coming in, they don't necessarily say give me BAF, but what they're saying is, can give me a product that can help me manage volatility, can help me get better return than fixed income. They can also tell me that markets going one side or the other side will not affect me too much. So you see, unlike you and me, they will not use the word BAF, but they're definitely going to pose that question in various forms and means, which we have to pick up, saying that we know what they want. When someone says, I want to be in equity, but I don't want the equity risk, I want in that proportion. I want to be in fixed income, but it's only for that momentary play where I can move in more into equity or get that liquidity sort of bit managed. And they say, I want to do this, but I don't have the time, or I don't have the bandwidth, or even I don't want to be regularly switching in. So we pick up those ins and know that clearly we see huge momentum and inquiries for these dynamic products, which are now very easily demarcated as BAF.
Yeah, when you say I want something healthy, but you don't want to spell out soup, you're hoping that
That's
someone
right.
a healthy sandwich. Okay, guys, Radhika, Santosh, thank you very much for your time this evening and for your very balanced views. And who's watching, I hope you enjoy yourself, and I hope you go back with some takeaways And if there are any further questions or queries or any clarity that you seek, do find us. All three of us on Twitter. So do reach out to us. But thanks very much for watching. And once again, Radhika and Santosh, thanks a lot for making it simpler. Bye-bye.
Focus, ideate, innovate, enable.